Good day. Thank you all for joining us for this market update. Emmett Corboy here with Wealth Cycle Advisors, and I'm very excited to have this timely and informative information brought to you from our partner, Chris Sajak at First Trust. Chris is going to walk us through some important information regarding what's going on in the market right now, everything from S&P 500 market concentration to tariffs, so on and so forth. So buckle up. We're going to have some great information. Chris, I'll let you take it away.
Great. Thank you, Emmett. Thank you to the entire Wealth Cycle team. And like Emmett alluded to, I want to walk everyone through a little bit about just how we see the market right now. That exists, or that certainly includes the market concentration that we see. A little bit of perspective just in markets in general, and then a little bit on tariffs, and then a small, tiny piece of how politics work their way or weave their way into the market. So why don't we go ahead and we'll get started. And again, I want to talk a little bit about index concentration and market breadth, really the lack of breadth that we've seen here recently. So this is a slide that goes back to 1985, so almost 40 years of data that is going to show you the top 5 companies in the S&P 500 index. So if we unbox that statement, this is the 5 largest companies in the S&P 500 index. The S&P 500 itself is actually 503 names, 503 stocks, but those will be the largest 503 stocks that are, companies that are domiciled within the U.S. So again, this chart goes back to 1985. And if you look, the top 5 as a whole, you could say on average, we're, a little bit less than 15% really for the first 30 years of this chart. The last 10 years, we have seen that, those top 5 names really skyrocket from a collective weight. So they are about 25% of the index right now. And why that's a little bit worrisome is just when you have so few names up at the top of the index that are really dominating from a weight perspective. If those 5 names don't do well, you guessed it, your index probably isn't going to perform all that well. And this isn't something that we just see within the S&P. It's also something that we see in the NASDAQ. We'll get to that in a little bit, but we have been here before, albeit not to this level. So in late 1999, you'll see the orange bar represents the top 5 stocks: Cisco, GE, Walmart, Microsoft, and Exxon. And you'll see late 1999, they were 17% weight within the index. And from really 2000 to modern day, that 17% eroded to 9%. So that's the worry here of, we're going to start at 25 or 26% now, and then maybe in 5 to 10 years, that'll be 15%, maybe 17, whatever. We just, we're a little bit worrisome that we're top heavy within the index. And again, I alluded to it earlier, but you'll see a similar concentration exist within the NASDAQ. So the top 5 names within the NASDAQ are 35%. So
Chris, just to back up to that last slide here real quick. So, what that kind of shows is, so the top 5 stocks, you said Cisco, GE, Walmart, Microsoft, and Exxon made up 17% of the S&P in 1999, 2000, but now it's just 9. So that kind of shows their relative lack of growth over the last 25 years relative to the rest of the index, correct?
Correct. Yep. And we're not here to say that Apple, Microsoft, NVIDIA, Amazon, and Alphabet are bad companies. They are not. They are, frankly, 5 of the strongest companies in the entire world. Right. It's just a bit worrisome that when they take up so much weight within the index, they have to continue to do really, really well just to hold their place in line at 25 or 26% weight within the index.
Exactly. Yeah. Sorry to interrupt.
No, that's okay.
That's great.
So, and you may be asking, well, how did we get here? And so this is a terrific chart. It's a rather confusing chart, so I will do my best to try and unbox it as neatly as possible, so to speak. So this chart goes back to 1995, and this shows what is called market breadth of the S&P 500. So market breadth is simply just the percentage of companies within an index that outperform the overall index return. So you can kind of think of market breadth as leadership. You know, how many companies or what percentage of companies in the index are really leading the way. And what you'll see is in 2023 and 2024, we had really narrow market breadth, meaning we had fewer number of stocks that were leading the overall index. And because those handful of stocks were the ones that were really driving performance, they were able to gobble up weight. And so if you kind of look at this, just this chart in its entirety, what you'll see is, you know, this 30-year history, a healthy market is somewhere in the high 40% range. So maybe like 46 to 49%. And again, in 23 and 24, when we had narrow markets, they registered 27 and 28%. So you can kind of see how we got to that 25 or 26% weight within the index for the top 5 names. So it's been our belief that we're going to begin to see a broadening out of the market, meaning more leadership within the overall equity market. And you've certainly seen that so far this year. And this chart only is the first quarter, so January, February, March. But you'll see we went from being a high 20%-ish range over the last 2 years to now 62%. And again, it's just a healthier market in our opinion. So I want to just kind of give some perspective, right? Because we've seen a lot of volatility here recently. And we always kind of like to make the comment of, you know, the Market Timers Hall of Fame is empty. If there was someone or some company that could time the market perfectly, we would all be investing with them. It is a very difficult thing to do. And so that's why we'll talk about it's really more important to have time in the market and not timing the market. And the next few slides do a fantastic job of illustrating that. So what this looks at is the S&P 500. If you were to put $10,000 into that index at the beginning of 1980, right now, or at least at the end of March, that $10,000 in the S&P 500 would be a little over $1.6 million. Now, if you miss just 5 of the best days within that 1980 to 2025 period, just 5 days, you missed those 5 best days, your 1.6 million goes down to $1 million. If you added the second 5, so if you missed the 10 best, your 1.6 went to 730,000. If you missed the 30 best, you'd be at $262,000. So this is a powerful illustration that it's really just more important to be in the market, not try and time the market, because more times than not, you'll see the best days are right around what you could consider the worst days, right? The days when the index or the market is down. And so we understand volatility is an emotional thing and wealth is an emotional thing. We think this slide does a really good job of showing you that, you know, maybe we're concerned, or at least what we're concerned about isn't all that bad. So this chart will show you bull markets in navy blue and bear markets in orange. And so you'll see these really big blue mountains, and then you kind of almost see these little orange valleys. And what you'll see is that the average bull market lasts a little over 4 years with an average cumulative total return of about 150%, whereas the average bear market lasts a little over 11 months with an average cumulative loss of 31.7%. So we're just showing you that, look, the average bull market is going to last a lot longer. From a percentage standpoint, you'll have a greater gain when compared to bear market. So we understand that those, you know, as I referred to them earlier as orange valleys, We understand that those are very tough times. Volatility is not fun for anyone, but just remember that the market is really resilient and will always, or should at least, come back, and you should be able to see some good returns when that volatility subsides.
Mhm.
And this chart, at least, it's a little dated just because it starts in September of 2007, but this chart will show you that if you got 7 different asset classes to invest in at the peak of the S&P 500, in what would really become known as the global financial crisis. So September 2007 was the peak in equity markets before
Right.
the financial crisis took place. And what we did is we essentially just tracked 7 different investments. So you've got stocks, gold, bonds, inflation, real estate, cash and energy or oil. And what this chart shows you is that even with all the tough times that we had in late 07, 2008, and early 2009, that stocks still won out. The best performing asset class since the peak of the market in fall of 2007 is still the S&P 500 and domestic equity. So some pretty good perspective to realize that, yes, we'll have volatility. Yes, we'll go through some challenging things from an equity market perspective, but keep your eye on the long-term horizon, because stocks typically do well and get through that volatility. And if you look at the probability of returns, if I invest in the S&P 500 in one day, the odds of me making money, it's essentially a coin flip, right around 50%. But as you'll see, our odds get better and better the more time we have in the market. So at 1 year, 77.4% probability of positive returns. If we go to 5 years, that jumps up to 93%. And at 10 years, it goes to 97.4%. So again, stressing the importance of time in the market and not timing the market. And lastly, this slide will look at the 99-year average annual returns within the S&P 500. So almost 100 years worth of data. And as you can see, positive years are going to be in navy blue. Orange is going to be negative years. What you'll see is out of those 99 years, we've had 73 positive years, and we've only had 26 negative years. Our average annual return for positive years, 21.5%. Our average negative return is 13.4. So interesting when you compare and contrast those two numbers. We're going to have a greater average annual return for positive years than we will negative years. And the one thing I always like to look at is on the far right, you'll see the years and the corresponding return for the years where the S&P 500 was up 20% or more. And then you go to the left-hand side of the graph and you look at years where you've been down 20% or more, and you only have 3 of those. So again, we're pretty confident that we're going to have more positive years at a greater average annual return than we will negative years. So
that's really interesting because, we think so much and hear so much about, stocks average 10%, right? The S&P going back to 1926 averages a 10% rate of return. But I love, looking at that within the context of in the years where the market's positive, we're actually averaging about a 21.5% rate of return.
Yep.
So that's a great piece there. Love that.
Yep. So a few slides on tariffs, because obviously it's a huge talking point right now, and certainly comes up in a lot of the conversations that I'm having with clients. So just some data around inflation, right? So early on in the Trump presidency this time around, we heard that tariffs are going to cause inflation. We figured to ourselves, well, let's go look at the data. Obviously, the Trump administration put tariffs in place the last time they were in the White House. So what this chart looks at is just the navy blue is going to be the growth of $10,000 invested, again, in the S&P 500 index. And then that orange line is actually going to show you the year-over-year percent change in the CPI. So it'll go from late 2017 to the beginning of 2020. And what we're showing is that, well, at least the last time tariffs were put in place, We didn't see any significant inflation as a result. And we certainly saw some volatility both with the actual CPI number itself, as well as the equity market in terms of the S&P 500. But you'll see that inflation, went up a tiny bit, and the S&P 500 actually went up a decent clip. So, that's really just to say that, it's going to be a wait and see as far as inflation is concerned. The one thing I'll mention, at least from a firm standpoint, is, we're not huge tariff fans. We're free traders. But again, we'll always take a look at the data and try and understand it as best as possible. And here we're just looking at the average effective tariff rates. And pre-1916, most of our federal revenue was generated through tariffs. So you'll see much higher percentage numbers as far as the actual tariff themselves that were put in place. More recently, because of a lot of trade deals with different countries and regions, we've been pretty low at 2%. And here you'll actually see the tariffs as a percentage of the federal receipts.
Wow.
Yeah, because of that, I believe it was the 16th Amendment in the early 1910s. We went from really, a tariff an economy that implemented tariffs as a way to get revenue, to the federal income tax as being the main lion's share of our federal revenue. So you'll see we're at 2% still. And now how we look across the board with our top 10 trading partners. And so our average tariff rate in the US is 3.3%. You'll see some of our trading partners, Japan at 3.7, Canada at 3.8, Mexico at 6.8. You can look at this chart and just say, we're trying to level the playing field. Obviously China, our second largest trading partner by dollar volume, is at 7.5%. You could look at India, certainly one of the beneficiaries of maybe supply chains getting disrupted and more of that manufacturing leaving China. Some of that's going to India. They're at a 17% average tariff. So our thought process is, while we don't necessarily agree with tariffs, just the implementation of them, hopefully it's to get these average tariff rates down for our largest trading partners. And if we just look from a dollar volume standpoint, you'll see that Mexico is actually our largest trading partner right now, followed by China in the second spot, and actually Canada is very, very close behind. So we could, recently or pretty soon see China, the Chinese market becoming our third largest trading partner, and Canada moving up to the second spot. And then I mentioned I wanted to cover just 2 slides on the elections, because it's always a topic that comes up, certainly in November, whether it's a presidential election or a congressional election. Here's a chart that goes back to 1949 and looks at the S&P 500 and the growth of $10,000. And you'll see 3 lines. So the red line is if you invested that $10,000 only when a Republican was in the White House. You'll see that your $10,000 would have grown to a little over $80,000. Now, the blue line is if you invested only when a Democrat was in the office, your $10,000 would have grown to about $464,000. Now, if you stayed fully invested throughout that time period, regardless of who was in the White House, that $10,000 would have grown to just shy of $3.7 million. So it's important to remember, at least from a market perspective, it's really about profits and not politics. Mm-hmm. And the one thing I do want to show, and then I can close up and take any additional questions, but this chart, same time period. So 1949 is when it starts. And what we did is we looked at, all right, who's in the White House, Democrat or Republican? And then we looked at the makeup of Congress, Democrat, Republican, or split. And so what we want to illustrate here is that regardless of who's in the White House, more than anything, you just kind of want lock up in Congress or a split Congress. You don't want one party to have too much power, because typically what we've seen is when we have that gridlock in DC, you typically have your best investment performance. So that was all I had for my prepared comments, Emmett.
No, so I thought we had a 3.5 year break until we got to talk about politics again, but appreciate you, bringing this up, because it is always pertinent information and, something that we want to keep in mind. I know, we've been speaking with a lot of clients around just, concerns with what's going on in Washington and how that can impact them, good, bad, or indifferent. And so it's important to note that, while we have, a changing of the guard, it's, not anything that we're not used to and haven't seen before. And, we know that over time, the economy is going to march forward no matter who is in office as well, right?
Yep.
So
market's resilient.
Yeah, absolutely. That's great. Well, yeah, Chris, thank you so much for, providing this information. Thank all of you for, tuning in for this as well. With any thoughts, questions, feedback, definitely reach out. You can reach the team at WCA@ceterainvestors.com, and you've got our contact information as well. Thank you all so much.